because there's not a lot going on in bonds, despite a lot going on everywhere else. Larry Shulver is our bond guy, he's the CIO of Efficient Advisors. So Larry, we've had quite a bit of economic data the past couple weeks. None of it has really been astounding, to say the least, since our last employment report. Is this why we still have 10 years hanging out at 2.65%?
You know, I think so, but let's keep this in mind. Like, you know, yesterday's data, by and large, underwhelmed, and the Treasury move was counterintuitive, right? Yields went up yesterday with bad data, especially durable goods.
Yep.
Yeah, Philly Fed, et cetera. But, you know, this is what we have to keep in mind. We had a 35-day federal government shutdown, and I think to a small or large degree, people don't believe the quality the quality of the data that they're seeing. And secondly, a cooling economy is kind of old news. It's kind of like baked into the market already, and I think that's why we're not seeing the steepening of the Treasury yield curve like we probably should be, given such a dovish Fed. So all that to say, I think, you know, the repricing in the Treasury market, in my mind, is going to come somewhere else. The ball is out of the court of the Fed at this point, and it's going to be geopolitical, it's going to be economic, it's going to be something else. And even we'll get more clues next week, of course, with the semi-annual address to Congress. But the trade deal, there's things that are so enormous right now. The Fed went from, you know, shades of dovish gray to being dovish right now, and that's why we're sitting where we're sitting. Okay, so I just want to kind of, you know, drill down into that a little bit, Larry, to make sure I understand sort of the logic behind it. Because when you say the Fed won't, basically the Fed won't be the driving force in the short term for the bond market, is the message I'm hearing? Yeah. Is that okay? So is that basically because, look, they've done everything they can without actually cutting rates, and so the event of either them cutting or the event of them doing another 180 and going strangely hawkish is low enough probability at this point to where there's going to be other things that have to drive this market? Yeah, I mean, I think that's what I'm saying. I mean, sometimes I don't know what I'm saying, but that's how I'm trading. That's how I'm trading. I feel, though, you know, the Fed made it pretty clear, pretty dovish. Perhaps the pathway to the one hike in 2019 is a lot more crooked, and that's why we sold off on Thursday. But that said, you know, what happened today was almost the opposite, where we had two Fed speakers come out pretty dovish, reassuring the market. And in that environment, you should think that the 2-10 yield curve should steepen. You should think 10 and 30-year yield should go higher. 2-year yield should stay pinned, and just the opposite happened. The dollar really didn't sell off. So in my mind, I think it's going to have to come somewhere else. And really a lot of pressure is on this trade deal. I know we've been talking about it ad nauseum, but, you know, it's coming up close. And I think, you know, given Trump wants to win again, I think there's going to be an incentive to make that happen. So there you have it.
So let's go intraday here for a couple days. Guys, bring up the bond chart, 5-day, just to look at what's been happening this week, or even 10 to take it back to last week too, because I thought yesterday was noteworthy as well, Larry, where we had a lift in yields despite, I think, objectively poor data. We're now in negative territory on the economic surprise indexes for the U.S., but yet there was this kind of phantom lift in yields, and it, you know, begs the question is, you know, how little of a surprise to economic strength will it take to kind of kick it out of bed a little bit? I mean, this is kind of something we've been saying for months, maybe even a year, but it still is the one thing we have to watch for, right?
Yeah, no, absolutely. And I don't want to be glib about that at all. We definitely have to be vigilant. It's just that the recent data, by and large, has been substandard, but we also had a pretty big government shutdown. I just think there's larger issues. I mean, a cooling economy is kind of baked into the market. That's why we're sitting in such a tight range. That's why vols are so low, like the fourth lowest reading since 1988. And I'm talking about the Treasury option market, not the VIX.
Yeah.
And so I really think that, you know, we see this in volatility all the time. You know, that coil gets sprung, gets stretched down so low. The repricing that we're going to see, is, in my mind, my bet anyway, it's going to come elsewhere, and I don't know where that's going to be. But all the signs point to continued flattening of the yield curve. Absolute levels not as important to me. But this today, the perfect example. We should have seen a steepening, and we did not.
Last thing, Larry, what does that mean for your positioning right now? Are you still as bullish, or is there less to extract from the downside for yields, upside for prices?
Yeah, I'm still holding flattening positions in the 3-month, 10-year. That's about 20 basis points. That's the one the Fed actually really watches the most, and also the 210. When it comes to absolute levels of the 10-year yield, to me, it's still anybody's guess. And given the circumstances that surround us, we have the debt limit, we have Brexit, we have the FOMC semi-annual. I don't know. I mean, it's just we've been in such a tight range. And keep in mind, you know, the S&Ps are up 11% on the year. I know you know that. And so the nominal benchmark has become a lot more relative because of that.